Although the S&P 500 had a very successful month, almost reaching all-time highs and taking a lot of companies along with it, there are still undervalued dividend-paying stocks out there for investors to take advantage of. In this video, I'm gonna give you guys 3 different dividend stocks that you should consider checking out. All 3 stocks are very close to their 52-week lows. So let's get straight into it with the first company, which is responsible for one of my favorite chocolate candies, Hershey. Hershey has a pretty impressive 5-year growth history at about 70%, but its past year hasn't been the best, currently at a decrease of about 20%, which we'll definitely get into the why in a little bit. Anyway, that downtrend in share price puts it at almost $20 away from its all-time low and almost $100 away from its all-time high, which is crazy considering how popular this company is, but it's a little less crazy when you actually look into why the stock is going down in the first place. Because of weather conditions and steadily increasing demand of cocoa regardless, prices have apparently doubled, making it more difficult to obtain the regular supply without spending extra money. That breaking news definitely is what caused the share price to go down, but I honestly don't see this lasting forever. And with that in mind, there are still plenty of upsides with this company. For example, its total revenues and net income over the past 5 years have been steadily trending upward. And of course, its dividend history is something I love talking about on this channel. Hershey currently sits at about a 2.82% dividend yield, meaning for every share you have, you get paid a little over $5 every single year. It also has a very impressive 11% growth rate when it comes to its dividend within the past 5 years, so a little over 1% every year, which is great, including an even better 1-year growth rate of 15%. And it's also had a great history of paying dividends to its shareholders with 34 years of consistent checks, including 14 years of consistently increasing those dividends. Although this definitely makes for a very undervalued position to take advantage of, especially for the long-term growth and the long-term passive income. Being one of the most popular athletic wear, lifestyle wear, and shoe companies within the entire global market, Nike has still surprisingly not had the greatest recent share price history. Despite the fact that it does have a 5-year growth of 12%, which is very impressive, the most recent year resulted in a 20% drop, including a 10% drop in just the last month alone. I couldn't find really an exact reason why the share price was going down, something that would make me actually want to sell. I know there's a few things that have been going on with this company over the past couple of months. For example, I know they had their release in their new breathable uniforms for the MLB, which was met with a lot of negative feedback, from the transparency to the multicolored features. It didn't go pretty well at the beginning. Aside from that, a few months ago it was announced that Nike and Tiger Woods would be ending their 27-year contract, and they also announced the manufacturing the Air Force Ones to be minimized to avoid oversaturation and to give room for other shoe models. And as historic as that shoe model and Tiger Woods respectively are, I can understand how that can make people feel a little bit uneasy. Despite that, the company does have some really nice dividend stats. Aside from the fact that their dividend yield is a little under 2%, which for me is not really something I would go for, but their PO ratio is at about 39%, which I actually appreciate because that means they're taking the majority of their money and they're reinvesting it back into themselves. They also have a 5-year dividend growth rate of 11%, along with the 34 years of consistently paying their shareholders dividends, just like Hershey, so that's a little bit coincidence. So definitely a lot of upside to investing into an undervalued stock like Nike, especially with its current share price being only $7 over its 52-week low. And speaking of popularity like Nike, this third company is definitely the king of pumpkin spice lattes. Even though it's known for being the most popular coffee chain and one of the most popular food chains in the entire world, Starbucks still has taken a pretty big hit recently. They've had a 7% drop in share price over the past year, including a 3% drop in the past month, putting this company also very close to its 52-week low. It seems like the reasons for Starbucks share price going down are pretty external. For example, you have the news of Starbucks along with other companies being boycotted in the Middle East due to potential involvement in Gaza, which is causing the company to lay off employees. And then we also have the news about the slowing of the Chinese economy, which for Starbucks is unfortunate because it happens to be the company's 2nd largest market. And it's also unfortunate because Starbucks food and drink prices aren't that low to begin with. But what makes this company a great undervalued position to take advantage of is pretty similar for the other 2 positions, including their revenue growth history consistently increasing over the past 5 years, their 5 and 10-year share price growth rate, which paints a great picture for investors wanting to hold for the long term, and of course their dividend history. They currently have a 2.49% dividend yield, which has increased by almost 10% over the past 5 years, so almost 2% every single year, which is definitely great. And that comes as part of a 13-year consecutive history of increasing and paying those dividends to shareholders, which I know for us who want that consistent passive income, that's definitely very important to keep in mind. So those are definitely 3 different attractive positions that I want to take advantage of in the upcoming months. But when I was doing my research, there are a few other companies that I could consider, but I personally feel like there's a bit of a catch to each. The first company is Apple. Now, Apple is a very strong position. It has an amazing long-term growth history, and the fact that it's just one of the most important companies in our society. I'm pretty sure they make up like 60% of the phone market. However, this company is definitely not known for its dividend payout. Although it has one which it pays out every quarter, it only pays out 96 cents per share per year to each shareholder. So not super attractive. Their share price has dropped in the past month, more than likely due to their antitrust law situation that they're currently going through. But again, this company is definitely not going anywhere anytime soon, so this is definitely a position you should consider, especially considering it is approaching its 52-week low. Just keep in mind its dividend is not the most exciting. The other company is UPS, and I have maybe only 2 shares of UPS currently, but I am a little bit hesitant to invest more at this point in time. On the good news, they do have a great dividend history from their yield to the 5-year dividend growth and their consistent increases in dividends. And they've also had success when it comes to their long-term share price growth. However, the past year has been pretty rough with the share price dropping by over 20%. And when it comes to the dividend, their cash PO ratio is ridiculously high, like over 100%, which should be a big concerning for shareholders if they're investing into a company that may or may not be able to continue paying the dividend that they're paying. So with that, I am hesitant into investing more into this company immediately because I'm assuming that the share price is going to go down, but at the same time, I'm not a financial advisor, so what do I know? But I know with them modifying regular UPS facilities and making them automated and making more automated facilities, that is going to substantially increase productivity, which is going to increase their revenue and ultimately increase their share price. So that's something that I'm definitely looking forward to in the future. These positions are going to be really beneficial for anyone that's looking to have a portfolio with long-term growth ability and long-term passive income with dividends that can consistently increase over the long term. But at least for me at this time, the amount of dividends I made last month was actually pretty nice. I talk about that in this video, so make sure you check that out. But I do appreciate you guys watching this video. Until next time, as always, take care.